in mortgage lending edged up to 2% in May in the context of a strong increase in demand, while credit standards tightened slightly in the second quarter. So in conclusion, the Governing Council today decided to keep the 3 key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you for taking my question. The first one is on the euro exchange rate. So we've heard from your dear colleague, the Vice President, Luis de Guindos in Sintra, that anything beyond 120 might be complicated. So what's your assessment? When does it start to get complicated? And when do the deflationary effects from that higher euro do start to worry you? Second question is on the tariffs. If we were to get that 15% trade deal with the United States, is that according to your baseline, and would that lift the uncertainties in a way which is good enough for the euro area to grow? Thank you.
Thank you very much for your twofold questions. Let me just tell you that in relation to exchange rate, we do not target any exchange rate. Second, we monitor exchange rate indeed, because exchange rate matter for our inflation forecast. And I'm here quoting my dear friend, colleague, Vice President, who said recently, we take into account exchange rate to forecast inflation. We are exactly on the same page in terms of our message regarding exchange rate. Your second question had to do with conjecture as to what will be the outcome of ongoing trade negotiations. And I know that there was a newspaper yesterday who sort of hinted that we were at a particular closure. It was a closing in, not a closure, right? And required very careful reading. We are attentive to where the negotiations are heading. We are not in a negotiating position. We are operating on the basis of the work that we do to forecast, to anticipate. We have a baseline on which we are basing our decision of today, which is our June baseline, which holds. You know, that baseline is generally confirmed by all the recent data that we have received. But we take things one day at a time. We decide meeting by meeting, but we take news one day at a time. And for the moment, we are relying on our baseline, relying on the scenario that we have done back in June, which we have published, which you all have had a chance to look at, and that's what it is. But one thing I will add to that is that the sooner this trade uncertainty is resolved, so I think we use the word resolved swiftly, so the sooner it is resolved, the less uncertainty we will have to deal with, and that would be welcome by any economic actors, including ourselves. Thank you.
Next question goes to Alex Weber of Bloomberg. Alex, please.
Good afternoon. Thank you very much. I've got two questions on your statement. So you highlight the resilience of the economy so far. Does this resilience reduce the need to deliver another rate cut in the autumn, even if this was part of the baseline scenario in June? And the other question is on your reaction function. So you added that future decisions will also be based on the risks surrounding the inflation outlook. Could you just explain why this addition was necessary? Thank you.
Sure. Thank you very much. And thank you for noticing the addition. You're right. So I'll start with that one. As you know, we concluded our strategy assessment. We had a strategy review that we concluded in 21. We had committed to review that strategy on the basis of new economic development and certainly in view of the process through which we had gone, namely facing those incredible shocks and going full cycle in many ways. So we did that, and as a result of that strategy assessment, it was determined that we had to amplify, enhance, and probably give a slightly higher focus to risk assessment. And obviously, scenarios, sensitivity analysis are part of that exercise that is conducted on a regular basis, that is published occasionally, but conducted on a regular basis. But it is certainly very opportune that this focus on enhanced risk assessment is agreed at a time when we have a higher level of uncertainty. So that's the reason why it is. You have the usual risk assessment section in our monetary policy statement, which focuses on growth and inflation. And we thought it was appropriate, given the enhanced focus that we want to give to the measurement of risk, the assessment of risk, to have actually that element included in the first part of our monetary policy statement. You know, we are, I'm going to repeat myself, we are in a good place. And we are in a good place because inflation is at 2%, but we're not focused on data points. We're looking at all sorts of data, and our target is the medium-term inflation, which is at 2%. So I'm saying that we are in a good place because our projections point to inflation stabilizing at target in the medium term. As you will remember, I have often mentioned the importance of wages. Wages are heading in the right direction and are showing this downward trend that we were expecting. The unit profit is continuing to buffer in a little bit of that wage increase, which is the natural result of an element of catching up and adjusting to the development of the economy. And we have seen, and I'm coming now to the specific point of your question, we have seen growth developing in a relatively favorable way. Of course, if you look at Q1 in particular, we will have Q2 in a week's time. But if we look at the numbers we have, Q1 was a surprising 0.6%. Now, of course, because we like to look under the hood, 0.6% is partly attributable to Ireland. And then if you look at what was actually driving this growth increase, it's partly front-loading because economic operators anticipated the rising of tariffs and decided to front-load. But it's not just front-loading. It's also increased consumption and increased investment, and not only attributable to Ireland, which is often an outlier for all sorts of intellectual property reasons and what have you. But so growth is developing mostly, if not a little better than in line with our expectations. So we are looking at development. As I said, you know, last time around, we are now confident that the inflationary shock of the past few years is now behind us. And our job now is to look at what's coming and to try to, first of all, wait, because there is a lot of elements that will pan out in the next few months, and see what impact it will have on our economy. Thank you.
And the next question goes to Balázs Korányi of Reuters. Balázs, please.
Good afternoon. Thank you for taking my questions. Two, of course. The first is about the risk of undershooting the target. Talking to some of your colleagues and reading more economist notes, it seems to me that there is a greater discussion about undershooting. In your discussion today, was there anything about this? Do you think over the last 6 weeks, the risk of below target inflation has increased? The other question is about the scenarios you published 6 weeks ago, and especially the more severe outcomes, which seem to suggest that even in case of retaliation, the whole package would be disinflationary. Now, I'm curious, is there consensus in the Governing Council about this, or is there perhaps still a discussion that such a scenario could turn out to be inflationary rather than disinflationary?
Well, thank you for your two questions. Concerning the risk of undershooting, I just want to remind you and colleagues that we are at 2% latest reading, but more importantly, because that's what we have to look at, we are at 2%, which is our medium-term target. So is there a risk of undershooting? There is actually a forecast of undershooting in 26 for all sorts of base effects reasons and consequences that we are forecasting today. But as has been mentioned by some of my colleagues in their various speeches, we are not going to be moved away by some minor deviation. And we are looking at the medium-term targets that we have. And we will proceed on the basis of that 3 elements to determine our monetary policy stance. So that is the result of our strategic assessment, but it's also the approach that we are taking inside the Governing Council. Now, you will always find 2 or 3 governors who are very concerned about the undershooting. But what I say to you is undershooting is actually in our projection, in the staff projection. It's there. But what matters is our medium-term target, because this is the objective that we have reaffirmed in our strategy, and which is definitely 2%. And when I look at my inflation expectations, it is strongly anchored around 2% in the short term, but also in the longer term. So that's as far as undershooting is concerned. Now, we have conducted that exercise with our scenario, and as you know, we have this sort of rosy scenario where everything is at 0, it's perfectly symmetric and reciprocated. We have the baseline, which is at 10%, which is the current rate that the economy is taking in, and we have the 20%, which is the severe scenario. Some of those scenarios have retaliation measures, not all. And I think that as we observe the interesting negotiations and what leaks out in various form, retaliation is optional, doesn't seem to be a definite element. But the ultimate net-off result in terms of inflationary forces or disinflationary forces cannot be determined at this point in time. Why is that? Because it's a very complicated set of factors that we will have to analyze, take into account to determine what the impact will be. We currently have a list of different rates. You have the hypothetical 10 or 15 or X%. We have some sectoral rates as well that apply to either the automotive industry or the steel and aluminium industry, a big question mark on pharmaceutical. And to add to that complexity, you also have the indirect impact on our economy of tariffs that are decided in relation to other countries that will induce some redirecting or rerouting, which themselves will have an impact on our economy. For the moment, we assume that this impact will be inflationary, and staff has worked on that. But equally, and this is very difficult to assess for the moment, there will probably be some bottlenecks issues as a result of the trade disruption. There will probably be, just as there will be some rerouting and redirecting, there will be some supply chain significant changes. And that will have also an impact on inflation, more likely to be inflationary than disinflationary. So it's not just, trade one way, retaliation in response, but it's also the rerouting, the redirecting, the supply chain disruption, the bottlenecks that will all come together to impact prices. Now, the next question you have to ask yourself as well, and that we are asking ourselves and will be asking, is that going to be a level effect? Is that going to be an ongoing consequence of a new paradigm? There is a lot of uncertainty out there. We are mindful of all that. We are going to monitor, factor in, model as much as we can. But at this point in time, conclusion is not, in my view, definite as to which of those forces will prevail.
Next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for taking my question. Good afternoon. My first question is on tariffs and interest rates, in the sense that the Federal Reserve would have cut interest rates if it weren't for tariffs, and Chair Powell said in Sintra, we went on hold for tariffs. Can you explain how far is the ECB today on hold because of tariffs? And my second question there again has got to do with the United States again, because Donald Trump called the signing into law of the Genius Act on US dollar-backed payment stablecoins a giant step to cement American dominance of global finance, the greatest revolution in financial technology, and secures the dollar status. But on monetary policy, there is a concern that the growth of stablecoins for trillions would have an impact on the short-term rates in the United States because of how much T-bills is going to be used as a peg to the stable coins. So there is a big debate on impact of this on monetary policy, on central banks, and I wonder if you can say, if you share these concerns of these innovations on monetary policy tools. Thank you.
Well, thank you for your two questions. I think it's a good expression that my colleague and friend and esteemed central banker has used to refer to being on hold. So we ourselves at the ECB, we have left our rates unchanged. And you could argue that we are on hold. We are in this wait and watch situation. And any monetary policy decision will, for the future, be decided on the basis of data, will be decided meeting by meeting, is not predetermined by any particular path. And I think that the jury is out as to how quickly the uncertainty will be cleared under present circumstances. So a large part of that uncertainty is itself caused by trade and tariffs, as well as non-tariff barriers, by the way. It's tariff barriers and non-tariff barriers, which obviously matter. That has an impact. The uncertainty in and of itself is also playing a role in relation to the level of risk that we see. So it's trade-related, caused by tariffs and non-tariff fear or expectations, depending on how you look at it. And it's the overall uncertainty about the outcome, which obviously induces different behavior on the part of consumers and investors. Look, on the Genius Act, first point I would make is that having a legal framework is helping understanding what the risks, benefit, and prospects are for these instruments. Number two, I think that it's a little bit early in the process to really have a clear and good understanding of what the consequences will be. Number three, we have to be focused on what we do here at home in Europe. We have to make sure that we are strong in terms of currency, issuance, protection. We are the curator of the euro, and we are ultimately focused on that. So, of course, we are mindful of what's happening elsewhere, what the dangers could be, but we have to make sure that at home we take all the necessary measures to protect and preserve our currency. And in that respect, we are very decisively focused on developing the digital euro and doing everything that we can to be on time and prepared to make this digital form of sovereign money available in the shortest possible time, which doesn't mean that it's going to be tomorrow, rest assured. And cash will always be there, and banks will be part of the game and will be intermediary in the process. But our duty is to make sure that as Europeans' preferences evolve over the course of time, the digital euro is a possible reality. Thank you.
And now Olaf Stolberg of the Financial Times. Olaf, please.
Thanks. I do have two short questions. One is on this interview Isabel Schnabel gave a few weeks ago when she said that the bar for further rate cuts is very high. Do you share that view, or do you have a different view on that? And my second question refers to views expressed by analysts who said that if the trade tensions will be resolved quickly, the question could relatively soon become when the next rate hike will happen rather than the next rate cut in the euro area. Do you think that's a relevant framework at the moment, or is this not relevant from your point of view? Thanks.
Well, thank you for your two questions. You know, each and every executive board members and each and every governor has their preference and their views. And I think it is the beauty of this institution to allow for diversity of viewpoints and for allowing the expression of those viewpoints. Now, my job as president of the ECB is to harness all the views of the Governing Council members and on the basis of our staff work, projections, proposals to elicit as large a majority view as is possible. That's my job, okay? So what I can tell you as far as today is concerned is that the decision to keep interest rates unchanged was a unanimous decision. I can also tell you that the risk assessment, which is nicely spelled out in the monetary policy statement, was broadly shared by members of the Governing Council. Now, as to future path, I think it's also widely shared by members of the Governing Council that we have to work on the basis of the data as they come in, that we have to decide meeting by meeting, and that to predetermine a path or preset the level or the material and significant development that would trigger one thing or the other is prospective and not part of the job that I do. Okay? I think my response is clear enough. Look, if trade tensions are resolved in short order, it will clear some of the uncertainty that we have weighing on the decision-making of consumers, of investors, of enterprises, and it will, of course, help us as well anticipate and model what the outcome of those tariffs will be. Could it lead to different movements? Future will tell. Our work will tell. I would not exclude anything, for sure. Thank you.
Next question goes to Santi Pignol of Market News International, M&I. Santi, please.
Thank you. Good afternoon, Madame Lagarde. My question is, we are now less than a year from the time when reserves are expected to slip from excess to ample. My question is, are you happy that banks are in a position to deal with the reduced reserve? And is the ECB happy that all the tools are in place for any early signs to stress in the interbank market? Thank you.
Yeah, I suppose you're talking about liquidity and the volume of liquidity. Yeah. Well, first of all, there is still plenty of liquidity in the system. The volume has reduced over the course of time, and it has reduced as a result of the reimbursement of TLTRO, which is now completed. It has reduced as a result of the discontinuation of reinvestment under the APP first and under the PEP second. But despite that, and the fact that our balance sheet reduces on a monthly basis, regularly, predictably, the volume of liquidity in the system is still north of 2 trillion euros. So to talk about limited liquidity in the system, I think is not the appropriate characterization. There is still plenty of liquidity. Added to which, there is probably more liquidity in the system than we had anticipated, because there has been less demand for banknotes, and that has an impact. And there are other technical reasons caused by the fact that governments eventually moved their own reserves away from the central bank to put them to better use somewhere else, which has, as a result, increased the volume of liquidity out there. But liquidity abound. Thank you.
Next question goes to Carlo Boffa of Politico. Carlo, please.
Hello, good afternoon. Thank you very much for taking my questions. I've got two. First one, the EPP lawmaker Fernando Navarrete, the parliament appointment for the digital euro, told Politico in an interview this week that the digital euro is a nuclear threat to force banks to act. Do you agree with the statement? And the second one is on the strategy review. Some analysts say that the bar for QE is now higher. Do you agree with this? And do you think it will have any influence on next year's assessment of the operational framework? Thank you.
You know, thank you for your very prospective question. The latter one I'm not going to address, actually, because you are jumping ahead. We have a review of the operational framework that will come in due course in 2026. So we'll take those matters as they come. The operational framework has been approved a few months ago. Let us just see how things work, draw conclusions from that, and then we shall see when we reassess in due course and in due time, that is in 2026. Now, on your first question, you know, I have a pretty simple understanding of what the digital euro is. And for me, this is the digital expression of cash, right? I mean, we all have cash. Well, most of you, I suppose. I do. I like cash, whether it takes the form of coins or banknotes. This is cash, and this is central bank money, if you will. It's sovereign money. But as technologies evolve over the course of time, and as the preference for payment evolves as a result, we need to respond to the demand of our European compatriots. And I see digital euro as the digital expression of cash. It's like digital cash. You can argue at the margin that in terms of, you know, absolute privacy, we're not exactly on the same page. You could argue that the cost of cash is higher than blah, blah. But in essence, that's what it is. So to argue that digital cash is a nuclear bomb, I think that's a little bit over the top. We're not holding nuclear bombs in our pockets, as far as I know. Thank you.
And the last question today goes to Mario Savova of the Bulgarian news agency BTA. Oh, I thought you had raised your hand. Sorry. Okay, well then it goes to Marta Pilar of Econostream, please.
Thank you very much. Good afternoon. Thank you for taking my question. Madame Lagarde, what do you think of market expectations calling for another cut, independent of when it is, especially given that the June projections already incorporate one more cut? Thank you very much.
Well, thank you so much for your question. You know, markets do what they have to do, and we do what we have to do, right? So what I said earlier is still valid. We are in a good place. We are well positioned to deal with turbulent waters and to deal with the risks that will develop over the course of the next few months. And I'm here referring particularly, but not only, to the risk related to tariffs. But you can include geopolitical risks as well. You can include a vast uncertainty, which might partly clear as a result of whatever tariff certainty we receive. So we are well positioned. We are in a good place. We have essentially closed that disinflationary cycle that we battled over the last months and which has led us to move from 400 basis points to 200 basis points with 8 cuts in a matter of 9 months. So we are in a good place now to hold and to watch how these risks develop over the course of the next few months. And we will have a new projection in September, and later on, we reassess at each monetary policy meetings. We do projections and we publish them on a quarterly basis, but we do that on a regular basis, and we will continue to do that in September, in October, in December, and on and on. And it's on the basis of that work that the Governing Council will decide what is the appropriate monetary policy stance. So I cannot tell you much more than that because it's been repeated twice in the monetary policy statement. I've tried to avoid repeating it too much, but our collective determination is, number one, keep inflation at 2% medium-term target. Number two, operate on a meeting-by-meeting basis. Number three, be data-dependent, and there will be plenty of that in the coming months. And not have any kind of predetermined rate path. Some people would like it. I understand that markets would like to have, you know, more anticipation of that possible rate path. No, that is not possible under the current circumstances. But, as I said, we are well positioned to wait and see. And with that, I wish you all a nice wait-and-see holiday. And I hope that you take time to rest, enjoy family moments, friend moments, and have a good time in this.
That was some great advice there from ECB President Christine Lagarde speaking in Frankfurt. Take a nice, restful holiday and enjoy some friend moments.
Friend moments.
This is Bloomberg Open Interest. I'm Matt Miller alongside Katie Greifeld. Let's get a quick check, shall we, on the major averages.
Here we go. We're 90 seconds into the trading day. You can see we're up very slightly. We had actually a big rally to close out yesterday. We got some big earnings report from the tech sector, and you can see that reflected in the Nasdaq 100, Matt Miller.
Yeah, absolutely a blowout in terms of Capex from Google, raising in another $10 billion. Big American companies are still spending an absolute ton of money, and that drove stocks higher.
That is an up arrow story. Let's get to a down arrow story. Underneath the hood, we're keeping an eye on Tesla. Elon Musk warned of difficult times ahead for the EV maker after the one of the automakers' worst quarters in over a decade. You can see this wipeout developing in Tesla shares, now down 8.6%, Matt Miller.
Yeah, Alphabet, as I was saying, said demand for AI products boosted quarterly sales. It will now spend $85 billion in total on AI development. That is an increase of $10 billion.
And I know you're excited to talk about what's going on with Alphabet's AI strategy. So let's get over to Ed Ludlow joining us, Bloomberg Tech co-host Ed Ludlow. And Ed, I do actually want to start with Tesla, though, because that is a dramatic move that you're seeing in shares this morning. And you think about what Elon Musk said, that, OK, maybe the second half of next year, maybe the end of next year, things are going to look very different. But we know that he has a tenuous relationship with timelines.
He does. He often overpromises on something happening and then misses the timeline, but gets there in the end. I mean, this drop on the stock puts it on track for its biggest decline, I think, since the first week of June, on a closing basis anyway. That Tesla wants to be judged by investors on its future as an AI and robotaxi company. But in the here and now, the factors that impacted earnings were that it is a company that builds EVs and sells them to consumers. The biggest year-on-year sales decline for more than a decade. The numbers overall roughly in line or just missing estimates, and then clearly a quantifiable impact, $300 million of costs from tariffs. And by Elon Musk's own admission, this is a transition period where they're trying to convince Wall Street that they are moving from this legacy of selling vehicles to consumers to a very different operating model in the future.
I have to say, Katie's the better journalist. She's more skeptical than I am, Ed. I'm a cheap date. So for me, the more exciting story is Google, right? 10 billion more in Capex, 85 billion. This is just a feel-good, big tech American story. Am I reading that right?
Yeah, it's AI-fueled growth. In other words, you see on the top line and actually the bottom line through its cloud computing business and operating income that the investment to date is starting to pay off, but at a higher cost. Raising Capex is really interesting. Most of the time in recent quarters, investors have taken that signal that a commitment to investing in AI is really good. What's so interesting, not just in Google's own print, but in the third-party data that we have for advertising markets, is that the core bread and butter business, which is search, is still doing really well, and they continue to grow in that area. But you know, other threads to pull on are like Google is committing to fight in this talent war, something that came up during the course of the earnings call and is a notable expense for them as well. But cloud momentum is really important. Just like with Amazon, it's highly analogous. Okay, there's all these regulatory and litigation threats to Google's core business, but cloud computing is going to be the growth driver going forwards. And in the quarter gone and the limited outlook we got, they gave us evidence of that.
And Ed, before we let you go, I do want to throw a little bit of a curveball and talk about NVIDIA. We got some interesting comments from President Donald Trump yesterday saying that he weighed an NVIDIA breakup, but was told it would be, quote, hard. I know that you are in Washington right now at the Winning the AI Race Summit. What was the reaction to this headline?
Right. The reason I looked down at my terminal, by the way, is that I think NVIDIA, as it stands, is on track for a fresh record high. So the president basically said, and I'm paraphrasing, go and look at the full soundbite. He had looked at breaking up NVIDIA because it was so big, because it had a monopoly in the market. And as we've reported at Bloomberg, we basically technically view a monopoly as anything greater than 70% ownership in the single market, which NVIDIA has. But when he got to know Jensen Huang, he decided he was a great guy. He changed his mind. But the story is getting a lot of readership. I don't know that it's having any bearing on the stock in the here and now. Jensen Huang was very prominent in the room yesterday. He sat immediately in front of the president during the president's speech. He was invited by the president to stand, a prompted standing ovation. But, you know, the biggest thing for NVIDIA is that the AI action plan, the 23-page document, it changes the tone and policy position, which is that America's technology companies, it seems, will be allowed to export their technology globally, including to economic adversaries like China, which is the main focus of investors right now. Right. The president's relationship, I don't know. There's a cautionary tale in Elon's relationship with the president.
Well, we're just seeing a tweet from the president that he wants Elon to thrive, but he says that, you know, every few days. And I think it's interesting that the president may wake up one morning and decide to break up one of America's biggest, most successful, most dominant technology companies, you know, and he could do it.
It's a little bit ironic that those comments did come at, again, a summit all about winning the AI race, and NVIDIA is winning the AI race on a number of different measures.
But he's not going to break them up for now.
It would be
Bloomberg
hard.
Tech co-host Ed Ludlow definitely would be a special edition of your program if that happened, so we'll watch for it. Thanks so much for joining us. His show starts at 11 o'clock, so an hour and 22 minutes from now. Oppenheimer Chief Investment Strategist John Stoltzfus joins us now. And it's funny, John, I was actually having kind of a dream about you the other night. Because I was dreaming of, we have on the Bloomberg terminal a list of the strategist's forecast, and you used to be at the top of that list.
Don't tell me I'm a used to be. I don't want to hear that.
7,100. Now, your year-end forecast is for closer to 6,000, and a big bear like Mike Wilson has a higher target than you. So what do you think now? As it looks like the U.S. economy and the U.S. corporate universe is firing on all cylinders.
Well, you know, the big question is what the question is composed of is what is your year-end target? And when we came in, the target that we'd put in last December was 7,100. But when April 2nd happened and those wild percentages, 50% and eventually with China, 145% threatened tariffs, that kind of stuff made us think we better pause with our target. We took it down to 59.50. Based on where the market wound up on April 8th, we looked really pretty optimistic with a 59.50 target, actually. And then it got exceeded. And the reason why it's exceeded is because there's been progress made in this. But we want to see some, we'd like to see something with Europe, ideally, something with Korea in addition to Japan and the UK. That would make us feel more confident that there won't be dislocations within the sectors in primary names that could make the end of the year number not look so good. But we have to say this, we're very pleased, and we never changed our recommendation to be overweight cyclicals versus defensives.
Right.
Favorite sectors remain technology, communication services, industrials, consumer discretionary, and financials, which I think of those four out of those are among the 5 top performing sectors since the low on April 8th. And we in the piece that we wrote, we said that we thought likely we would have to change this because we didn't think that the April 2nd numbers were actually.
You're welcome to do that on this show, by the way.
Okay.
You can front-run yourself, front-run your publication. For those following along at home, you can follow the horse race by typing SPX Index ANR on your Bloomberg terminal. So it sounds like this is subject to change. You mentioned trade as being a big factor there.
No.
But what about earnings? We're really getting into the meat of earnings season.
That's the thing. It's I don't think it is nothing like what some people expected in second quarter earnings season where you see the effect of tariffs. There's some effect and some effect of just the way companies are changing how they're positioning that affects earnings when they change where they're sourcing things from or what have you. But we think that's further out. But if the numbers come down and it looks like 15% is the new 10%, and people seem to be kind of happy with it around the world because they look at it and they think, well, it'll affect the exporter, the importer, and the consumer, but it's diffused among the three and to different degrees depending upon what is the input cost affected, or is it a product or a service, what have you. So, you know, we think this is so far so good. That's the remarkable thing, and we like our call where it is in terms of being bullish, but at the same time recognizing that there's still some risk within this tariff regime and where it arrives at. But yesterday, the news on Japan, or was it the day before? I mean, time gets compressed these days.
Circle.
Yes.
You know, this is good stuff. And I think that the ECB essentially just in today, what we heard today, their actions shows they're looking at this. Perhaps they would come to the table too. And ultimately, we think it's fair for the U.S., fair for global trade. If you charge me a tariff, I'll charge you a tariff. If you want no tariff, let's go no tariffs.
Well, if that second option were on the table, I think a lot of countries would take it. It doesn't seem to be.
No.
What about the U.S. consumer? Yesterday we were talking with Anastasia Amoroso, and her assessment, I think she cites the Tax Foundation, is that most consumers are going to end up with 5% more after-tax income since the one big beautiful bill. That would be a great thing for consumers,
well,
right?
I think that's part of the thing about what the OBBB, the OB,
1B3.
It's when you look at that, you think there's a lot of things that are designed to offset negatives on this, and if it works out. And I think it's got a really good chance because trade is so important. The whole world is so interdependent on trade. The big news of this thing, I think, ultimately is what we've been saying for years now, is its diversification from one country centricity in terms of the global supply chain coming out of this. We're going to bring some businesses back here, those that are important for national defense, to make sure we have all kinds of drugs if we got another pandemic accessible. We don't have to be desperately waiting for a foreign source to ship stuff to us. But I think the reality is both the U.S. consumer and U.S. businesses like to buy globally because they get better deals that way. And Americans love to shop, and shoppers love good deals. And whether it's for quality or just on a commoditized product. So I think this is, this has been a year that has most certainly brought the Tums and the Pepsid back to the trading desk. But what we must say is it looks like the future looks substantially better than the bears would predict.
Yeah, we're all dealing with horrible acid reflux. John, unfortunately, have to leave it there. Hope to speak to you again soon.
Great.
That is John Stoltzfus from Oppenheimer. And it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Oppenheimer is upgrading Spotify to a buy, citing many tailwinds ahead. The firm sees significant opportunities for the company to monetize users. Shares up 2.4%. Next up, we have Deutsche Bank upgrading rail giant CSX to a buy, citing the increasing potential for consolidation in the railroad space. We heard from the CSX CEO saying that he's open to merger talks with other companies amid reports that Union Pacific and Norfolk Southern are in advanced combination talks. We'll have more on railroad deals later ahead. And finally, Wall Street is weighing in on Tesla after CEO Elon Musk warned of a hard year ahead. Wedbush analyst and Tesla bull Dan Ives describing Elon Musk as a, quote, wartime CEO who is sharply focused on high-stakes initiatives. He joined Bloomberg TV earlier today.
AI is the future for Tesla. So to me, yeah, it's a rough few quarters ahead, but I believe autonomous, we are in the beginning. What's going to be $1 trillion valuation alone for Tesla. So that's why I don't get so concerned when we talk about deliveries, which actually were kind of in line. When we look at what's going to happen in the second half. The story here, when it comes to physical AI, two best ones out there, it's going to be Tesla and NVIDIA.
All right, Dan Ives there, and if you're, well, I hope you're watching, because what a fantastic outfit. Let's talk more about Tesla right now with Jed Dorsheimer, William Blair Group Head of Energy and Power Technologies. He recently downgraded Tesla to a market perform rating with a $333 price target. Jed, great to have you on the program. You didn't dress up.
Yeah, thanks for having me back.
Yeah. I wonder what you think about the difficult quarters ahead, as Elon Musk put it, for the company. As a car maker, they certainly face problems. Is that true also as an AI firm, as a robot maker, as a robo-taxi operator? What is Tesla actually doing?
Well, they're doing a lot of things, but I think the challenge, with what Dan was talking about is the question is, how much patience will investors have? And I think there's a willingness to look through for those future opportunities, in particular, robotaxi. Now, that being said, Elon last night put out, a very aggressive, really, I think most investors are going to have a tough time believing that they're going to be able to address half of the U.S. population with robotaxi from a very small sample set of Austin by the end of the year. So that kind of egregious target, combined with what you're going to see is a cliff on margins or profitability, is the, by the way, I like the OB3. I'm going to steal that now. So as you look at the OB3 impact on the tax credits and the regulatory credits, which hit in Q4, that's going to be the time frame that's going to be tough. This quarter, we expected things to be a little bit better or last quarter and Q3, you're also going to get a pull in on demand. The issue is going to be Q4, Q1, and how long it's going to take to scale robotaxi.
Judd, it feels like we're potentially reaching a really interesting precipice for Tesla, the stock, because for so long, I mean, this is one of the companies out there where the CEO is so able to sell the future vision, even as the fundamentals in real time worsen. And now you think about some of the things that people are most excited about, a lower priced model, perhaps humanoid robots. It just feels like it's getting to be a tougher sell when you start to line up these timelines.
Sure. And listen, we've been through this before with Elon and with Tesla. I covered the stock back in 2018. So I remember when, it was the S and X, and the challenge was, can you go from a high price, low volume to a low price, higher volume on the 3 and Y? And it was really challenging. Remember, there was a lot of questions back then, and Elon ultimately prevailed. And we're not betting against the company long term or the stock long term. I think, the position is there going to be an opportunity? Is there going to be an air pocket that allows the stock to come in to lower levels, and we should be more tactical about just sort of, buying and closing our eyes to what the fundamentals show? And that's probably an area of differentiation. I do think that there are very promising, Elon talked about the energy business. That's an area that we focus on. It didn't get a lot of attention, but very profitable. And we're going to need more of that. We're going to see the grid strain more and more. But it didn't do well, right, Jed?
It didn't do as well as had been expected.
Well, the profitability is coming in much higher than expected, and the need for those mega packs and the Powerwall are only going to be increasing. That being said, it's not large enough, to offset what you're seeing in autos. And the real driver is going to be robotaxi. That's the meat of the valuation in their ability to scale.
Why is robotaxi so important? You've said this in the past. Dan Ives has been beating this drum forever. Why don't I get that? Because, Waymo already is there with a much more successful platform with much more experience. And once that nut gets cracked, everybody is going to be there. Why does Tesla have some sort of advantage?
Well, it's a vastly different approach. So if I look at Waymo is, 6 years into this process, and they have a cost structure that is very high. So when you look at that vehicle, that cost is going to be up 120, 150,000. When you're looking at what Tesla is doing by removing the LiDAR systems, removing the pre-programmed maps, that they can get to 1/10 the cost structure. So it's a much more aggressive, and so if you can get 1/10 the cost through the neural net and through the vision only, and keep the safety and meet regulatory requirements, then your ability to weaponize price and scale and take market share is much greater. And so that's the real opportunity and the difference. So you're not going head to head with two of the same technologies. You have vastly different approaches here. And there's some questions over, if you look at Waymo has to partner with Uber. We look at Tesla, they're trying to do the vertically integrated with a lower cost structure. So will they be successful? If they are, to the victor goes the spoils, and that's the opportunity.
And Jed, we don't have much time left, but we spoke to you earlier this month because you downgraded Tesla to a market perform. And I'm curious,
Yes.
Now that we're through the earnings, we heard from Elon Musk, what would you need to see to bump you back up to a buy equivalent?
Well, we need to see better data on the scalability of robotaxi, to get more comfortable with the time frame. In our model, we have material revenue coming in 28, and we have that, ramping in 27, but that leaves a year and a half as a gap on the profitability. So we need to see that come in a little bit so that there's not as much of, you can't have a year where it's a complete redo in terms of, reset of expectations. And street numbers are still too high. So as street numbers get reset, we get better visibility on robotaxi. That would get us more comfortable with being constructive on the name.
All right, Jed, great having you on the program. Hope we get you back soon. Jed Dorsheimer there of the William Blair Group. Let's take a look at what's going on in stocks right now. On our dashboard, you can see the S&P 500 is putting up a gain of 0.2%, 63.72 would be obviously a new high there. The Nasdaq today, it wasn't this way yesterday, gaining more than the benchmark index, up 23,000. By the way, we're going to talk to the Nasdaq CEO, Adena Friedman, in the next hour. Definitely an interview you don't want to miss. They had the best first half for listings since 2021.
Yeah.
Which I think is a pretty amazing story. You can see Alphabet, Google shares in the corner there, up about 2% right now. So investors like that. They don't like Tesla, but that's a very volatile stock. So a 7% move in Tesla is like
it's a sneeze.
It's like a 2% move in a normal stock. $307, so still about $25 below Jed's target. And he lowered that. So United Health Group and American Airlines both down. Union Pacific and Norfolk Southern are interesting, moving in different directions. And this is something that we're going to talk more about because a deal in the railroads industry, I think, is more interesting than the actual sentence makes it sound, right?
Yeah, no, and this is a huge one in particular. So let's welcome in Lee Klasko. He is Senior Logistics Analyst for Bloomberg Intelligence. So combining Union Pacific and Norfolk Southern, this would be the sector's biggest deal ever. Before we get into potentially who's next, just talk to us about how this combination might reorder the industry.
Yeah, hi, thanks for having me on. You know, the rail industry is relatively consolidated right now. You have two large Western players, Union Pacific and Burlington Northern, and two large Eastern players, which is CSX and Norfolk Southern. Union Pacific this morning confirmed that they are in fact in talks with Norfolk Southern. This is confirming news reports that have been going out over the last, I guess, week now. And so what that would do is that would create a transcon railroad, which we don't really have. We saw a recent acquisition of CP, Canadian Pacific, and Kansas City Southern, creating a single line NAFTA network, combining, connecting Canada, the U.S., and Mexico. So this will be, a very transformational merger, assuming, though, and this is a large if it can get regulatory approval, and there's certain rules by the STB that makes it a very high hurdle for them to get over. So it could take a long time before we find out whether or not they do get that approval, even if they, ink a deal in the coming weeks.
Lee, explain to us, like if you're sitting next to somebody at a dinner party and say, I analyze railroads, and they, doze off. The importance of these networks to the U.S. economy is just massive.
Absolutely, and no one ever falls asleep when I talk. So that's first and foremost. It obviously is important. It's the lifeblood of the economy. All freight modes, whether it's railroad or trucking. Railroads are great because they are more fuel efficient than trucking. They're 3 to 4 times more fuel efficient than trucking. So it's lower emissions. Also, they tend to be cheaper than trucking. So for shippers, it tends to be a good product. The trade-off that you have is service, and railroading, just like anything else, like a lot of the railroads like to say, it's an outside sport, and they have to deal with severe weather and issues. And the real big difference, though, if there's an outage on one of their main lines, it really can have ramifications for service across its whole network. And so the rails have been great with intermodal, which is very truck competitive, and they're also very key to move heavy stuff like coal, ag, that sort of stuff across the country.
All right, Lee, I think you have a cool job for what it's worth. That is Lee Klasko of Bloomberg Intelligence. Should also mention quickly, shares of CSX also higher. A lot of speculation about whether they're next to be bought.
You weren't going to
mention Crazy Train?
Crazy Train.
Crazy.
What an important...
Rest in peace, Ozzy Osbourne.
Coming up in the next hour, Nomura is chairman of investment management for its plans for U.S. expansion. Then we're going to talk to the CEO, as I said, of the Nasdaq. This is Bloomberg. We are are 30 minutes into the trading day and looking at brand new all-time highs. Welcome to Open Interest. I'm Matt Miller.
I'm Sonali Basak, and Matt, all-time highs are getting kind of boring at this point, aren't
Not
they?
for me, no.
We keep on seeing them over and over, and we're seeing, of course, that even despite a little bit of a tick up in the 10-year yield. We are also seeing, of course, optimism coming back to that AI story after Google's results. But coming up, we're going to talk about optimism around trade from Japan to Europe. The U.S. may be on the brink of yet another trade deal, Matt.
And on the earnings front, as you mentioned, Alphabet's AI spending needs are set to skyrocket, while scandal and competition weigh on Tesla.
Scandal. And Blackstone's retail machine is mitigating the pain of a sluggish stretch for deal making. We're going to hear a little bit of our conversation from President and COO John Gray.
All right, we've got, as we often do at 10 o'clock, some breaking news on the economy crossing the terminal. Today we've got housing, new home sales, I should say. 627,000 is the number. We were looking for 650, so near as damn it to it. And that's still an increase over the 623,000 that we saw in the last reading. So not the disappointing number that we saw on existing home sales, unless you go to the month-over-month number, where it's only a gain of 0.6%. And we had been looking for 4.3%, and the revision down 11.6%.
And this goes back to what investors are looking for. Even if you have some cooling of rates on the short end of the curve, does the long end keep mortgage rates higher, therefore stifle some of the economic activity?
By the way, that is, for me, the question. Every time I hear Donald Trump or Howard Lutnick or Scott Bessent say, the Fed just needs to cut by 400 basis points, you know, is that really going to move the 10-year yield down? I'm not sure if that would do it.
Yeah, certainly a lot of skepticism. We're going to have Joe Lavorgna on later in the show. We'll ask him about it. But this morning, I caught up with Blackstone's John Gray about the macroeconomic environment, and he seems to think that the Fed can cut sooner.
6-12 months from now, tariffs and tariff diplomacy will not be the main thing. And the U.S. economy has shown incredible resilience. And at the same time, we have this AI revolution coming towards us, huge investment around that, and the productivity gains that should come give us a lot of confidence.
And joining us now, Chris Willcox. He is Nomura's executive officer, head of wholesale, and chairman of investment management. You hear some optimism coming out of the buy side. Is the same optimism coming out of the global sell side? Because we have seen still a lot of uncertainty when it comes to trade deals. Yes, we got something closer to comfort with Japan, but do you see that continuing on?
Yeah, I think the world is a more stable place than it was. I mean, if we go back a few months, we were spending a lot of time talking about the Middle East. Not that the Middle East is resolved, but it's certainly quieter. When we think about the trade uncertainty, the level of uncertainty's come down because we're seeing some deals getting printed. Most recently, one close to home for us, which is the Japan deal that was announced just over a day ago. So I think absolutely, as you saw from the previous speaker, that the volatility of where people think the outcomes can end up is narrowing, and that's a good thing for the market.
I was listening to surveillance on Bloomberg Radio this morning. They had a guy on, John Mowry, the CIO of NFJ, and he was saying in terms of the 15%, he expects that to be spread out. Some Japanese companies will eat a little bit of it. U.S. companies have fat margins. They can accept a little, and Americans will have to pay a little bit more. Do you see those tariffs being distributed, you know, in a way that makes them not as bad as 15% sounds?
So I think tariffs are just really, really complicated, and people that think that they understand what the sort of correlations and knock-on effects of them are probably guessing. I mean, it's certainly true that in your sort of B2B world that some of these companies probably can pass some of the costs on to their clients. I think what we're finding in the B2C world is that's a little bit tougher. And, you know, so there will be a real differential across which businesses are impacted. I would say when you think about the impact of tariffs on inflation, we are starting to see in the US, if you dig into the data, that the prices of goods that are related to those places where tariffs are being imposed are starting to move up. So I think you're going to see real effects from this, yes.
So what's interesting is you have a market in the U.S. that is looking for the Fed to cut rates as early as September, maybe December, but you have also at the same time Japanese yields moving much higher. This has been a generational trade that has been unwinding. What are the implications of it? There are a lot of questions about the market in Japan and whether this will redirect capital flows. What are your clients saying?
Well, so I think, first of all, the clients are relieved that there's some resolution. So whether it's 15%, and obviously bearing in mind that there's a big difference between the reciprocal tariffs, the sectoral tariffs, some of the existing strategic tariffs. So it's not a clean 15%, as Matt said, it's varied. I think when it comes to the US monetary policy, our view has been that the Fed was going to wait, and it's still our view that the Fed doesn't go until December. In the Japan world, I think there was a lot of uncertainty, a lot of nervousness, which was driving the long end of the curve in anticipation of where this tariff deal might end up. That's resolved itself. But I think there's something very interesting going on, which is if you look at what's happened across various of these periods of volatility, think about the gilts market in the UK, think about the long end here, think about the JGBs now. When we see rate markets sell off into these periods of uncertainty, when resolution arrives and the markets recover, the long end is not recovering anywhere near as much as the rest of the curve. So if there's one sort of concern that sits out there right now, it's how the long end of the curve performs. And I don't think that's purely related to monetary policy. It's related to a whole range of other concerns, including the uncertainty that we still have around tariffs, including some of the narratives around Jerome Powell and the independence of the Fed, and also, obviously, across a lot of countries, the fiscal position of these countries.
So certainty is key, and the volatility that we've been seeing in the first half has kind of freaked everybody out. We've been poo-pooing M&A, poo-pooing IPOs, and yet we're about to talk to Adena Friedman from Nasdaq. They had the best first half for listings since 2021. Are you seeing that as well? Are you feeling that as well in markets?
So very clearly on the M&A side, we've seen the deal count drop. In fact, the deal count's dropped to probably the lowest levels we've seen in many, many years. But the value of the deals that have been transacted has not dropped anywhere near as much. In fact, it's remained relatively stable. And that's been driven off the back of a few mega deals. Now, for us, the picture is very different because Japan has been a very hot market on the banking side and in M&A and IPOs. And we've actually had close to record performances in that space. In fact, in the global M&A tables, we're currently number 11, which is probably the highest we've been. And that is driven by the strength of the market, where we obviously have a leading market position.
And part of that is because you do see a favorable atmosphere from Washington around these deals. You even saw Nippon Steel and U.S. Steel end up going through at the end of the day. How far does that go? Does this mean all of your clients are dusting off all their dream deals and say, get it done now while President Trump is still in office?
I don't know whether there's a correlation to President Trump being in office, but I think that for sure, as some of the uncertainty in the market resolves itself, we're starting to see the pipelines build. There's clearly, I think, again, from your last speaker, there's a lot of dry powder on the sidelines in the private market side, which is looking to be deployed. If you look all across the origination businesses that we have, the pipelines are building strongly in securitized products as well. So for sure, the resolution of some of these trade deals and a greater degree of stability generally is leading to pipelines building. Whether those pipelines get realized depends on whether we get any further unexpected events. And there's plenty of uncertainty out there still this year. I think we're going to have an interesting year.
Yeah, for sure. Well, it's fascinating so far. Chris, great to have you on the program. Hope we get you back. Chris Willcox, they're Nomura's executive officer. He's head of wholesale, and he's also the chairman of their investment management. Let's get a look right now at some of the single stocks moving at this hour. Bloomberg cross-asset reporter Emily Graffeo. Emily, Alphabet and Tesla have to be on top of your list.
Yep. I mean, those are the big tech stocks that reported earnings yesterday. Alphabet, the parent company of Google, was rising to the highest level since since February after the company beat on second quarter revenue and profit. They said demand for AI products boosted sales, and that requires a big increase in spending. So they boosted full year Capex, that forecast, to $85 billion to help meet that demand. Tesla is not faring as well this morning. That stock now down over 8%. Elon Musk warned of a hard year ahead for Tesla as the company loses EV incentives in the U.S. and needs more time to roll out autonomous vehicles. That stock now down over 25% this year. But if you go over the last 12 months, it's still outperforming the S&P 500 pretty steadily. I'm also watching shares of two railroad companies, Union Pacific and Norfolk Southern. They confirmed this morning that they are engaged in advanced discussions regarding a potential merger. This follows news last week that Union Pacific was exploring an acquisition of Norfolk Southern. We see right now Union Pacific falling, Norfolk Southern in the green. Not too many large moves here, but movement nonetheless. If the two companies do combine, it would be the largest railroad deal ever. So watching that space. Finally, I'm watching shares of United Health here. That stock lower this morning after the health insurance said it's responding to criminal and civil requests from the U.S. Department of Justice about its Medicare practices. The company right now is confirming reports of probes that have surfaced over the last 2 years. They said they're cooperating with the DOJ, but this confirmation of the investigations just adds to mounting troubles here for United Health. They replaced their top executive, and they also withdrew their guidance, and that stock really under pressure here year to date. Look at that chart. It's down over 40% over the last year, Matt and Sonali.
Emily, we thank you so much for taking a look at things moving under the hood, but also moving Nasdaq. The first half listings notch its best year since 2021, and you also have Nasdaq surging today. It's now at a record high. It's surging the most since those volatile days in April. We're going to speak to CEO and Chair Adena Friedman next. This is Bloomberg Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. President Trump is visiting the Federal Reserve later today to tour a construction site that he's criticized for cost overruns as he ramps up his attacks on Fed Chair Jerome Powell for not cutting rates by 300 basis points in one fell swoop. Yesterday, the president was at an AI summit in Washington where he signed executive orders to boost AI development by loosening regulations and expanding energy supplies for data centers. The president also said he considered trying to break up NVIDIA until he realized how difficult it would be. And Tom Hayes, the former UBS trader cleared of manipulating LIBOR by UK judges, says the other traders convicted of rigging interest rates should have their cases overturned as well. Hayes spoke with Bloomberg's Anna Edwards earlier.
We never put rates forward as submissions or asked for rates to be submitted that were false. Were they commercially influenced? Yes. We can have a morality trial about that. That was a system. The benchmarks were set up by the banks for the banks. The whole thing was just badly set up. And it's all very well after the event 10 years later to say, well, we don't like the look of this and somebody's got to go to prison for it. But no one lied.
Let's turn now to the latest earnings news. The Nasdaq saw its best first half for listings since 2021. Despite the volatility around trade and policy, the exchange also beating profit estimates in its second quarter. Let's get details now with Adena Friedman, Nasdaq chair and CEO. And Adena, great having you here. I have been talking about this all morning long because I think it's such an amazing sign for markets. Tell us how you navigated this first half.
Yeah, well, first of all, we're really proud of the overall performance of the business. So we had 12% revenue growth, 24% EPS growth, and it really was growth across all of our divisions. So as you know, we have our financial technology division, 10% growth there, really great momentum with our clients and the strategic capabilities we offer around risk management, anti-fin crime, trade infrastructure. And then we also had 9% growth in capital access platforms, which includes our index business, 17% growth there, as well as our listings and data and analytics businesses. And so the listings business has definitely improved as we've gone through the year. As you mentioned, we had 83 IPOs in the first half of the year and 3 of the top 5. So
that was unexpected. I mean, we have been, I think, talking down to some extent the potential for exits and IPOs in general, and it's really beaten the street.
Well, I think that, first of all, the companies that have come out, particularly the large cap companies, have done well so far this year, which is, of course, giving investors more confidence in underwriting that risk capital, giving companies more confidence that now may be the time to come out. We're having a lot more conversations around putting dates on calendars, really focusing on post-Labor Day, but with some companies coming out over the summer as well. But that post-Labor Day period, if the economy stays healthy as it is, if the markets stay healthy as they are, and we obviously saw a lot of volumes in the second quarter as well that drove our results. But I think we could see a very active second half of the year.
Also curious about the limitations, because really strangely, you've seen a lot of the companies that came out, like Circle, just soar. A lot of crypto companies, a lot of Bitcoin SPACs that are making it to market now. So what does this mean for the types of companies that will do well in the future? A little earlier, I was talking to John Gray about Medline, which was supposed to be one of the year's biggest IPOs, yet we haven't seen it yet. So what's still being impacted that can't make it out yet?
Well, I think, yeah, it is. You're right that it is sector specific. So if you think about the companies that have come out and done well, biotech is starting to really come back. We're having more companies. We had Caris Life Science come out in the quarter. Really excited about that. But also tech, software, AI infrastructure like a CoreWeave, as well as areas in the crypto space. So those are all what I would say more digital-oriented companies. Companies where tariffs may still have an impact are taking a little bit longer to understand the nature of the markets and how to allow investors to have predictability in their earnings. And I think that those types of companies that have more dependence on what I would call the physical economy, they're taking a little bit longer to get out the door.
Meme stocks have come back in a fairly interesting way, and I guess retail trading is just driving this higher. Do you feel that as well?
I think retail has been very active in the markets. Definitely, you saw a lot of a significant
retail
increase.
drove us back from the April 2nd drop, right? But is it even further accelerating with this new meme stock?
And can it keep going?
I mean, I can only say retail's been an active participant in the market now for 5 years. COVID really brought a new generation of retail investors into the market. Those investors have been very sustainable. They've been very resilient. They're very active in the markets as well, driving up interest in indexes and index products, as well as the fact that they're very active in the markets. And we did see an increase in retail volumes second quarter this year versus last year. So we're definitely seeing a very active retail engagement. We're also selling our data around the world, so it's global retail. So our data business was up 7% in the quarter, and that is really driven by international demand for our data. To have their interest in U.S. stocks is continuing to grow, and we're going all over the world with that data today.
Speaking of data, the sister is AI, right? And so when it comes to AI, I know you're rolling out more products to banks and financial institutions later this year, AI agents that could help them with a lot of the parts of your growing business in financial technology, anti-financial crime. What does this do ultimately to save costs for others at the end of the day? Does it mean that headcount can be reduced by any means?
Or for you?
Yeah, so basically we evaluate our products and look at how do we create new capabilities to make our clients more efficient. AI is one of the biggest unlocks we've seen in many years. I mean, so first, we've moved our product base into cloud. We've modernized the data management that underpins our product base, and particularly with Verafin, which is our anti-financial crime suite, we've leveraged AI for many years to root out criminals, and now with agentic AI to make the workflows a lot more efficient. So the new thing that we've launched are these digital workers. They're agents really that come in and basically they do all the assessment of the alerts, they do the write-ups, and they do the submissions, so that you're taking down the actual workload of the humans within the group by 80%. So that is a huge efficiency opportunity for the banks to be able to solve this problem more successfully and more efficiently. And then we're also doing it in AxiomSL. We're starting to bring in basically agentic capabilities to make it so that we can do the regulatory reporting there, surveillance. There's a lot of places where efficiency can be gained here.
I wonder about the tokenization that we've seen at Robinhood. They're allowing Europeans to trade U.S. securities through tokenization.
Without having the underlying cash flow. I think that's an important part of this, too.
How do you view that, and what can that do for the industry?
Well, so to me, tokenization is a technology. It's a way to, so the technology itself can be used to do a lot of new things. But when we're looking at how it's being used right now in public securities, I think that it's really kind of a very similar construct to contracts for difference, which has existed in Europe for many years, where you own a financial interest in the company, but not the underlying shares themselves. We also have things like fractionalized shares in the United States and owning fractional shares. It's the same kind of idea. So far, what we've seen in terms of that tokenization is really just a new technology to deliver a similar thing where you can have a financial interest without actually owning the underlying equity. At the end of the day, that underlying equity ultimately does need to be bought, though, and owned, and that then, of course, flows into the market. So to us, this is just another way to use that technology to open up access to retail.
But will you use it too?
So we provide the foundational infrastructure that allows retail brokers to offer things like that, to allows the data. The data is super important to that. We have obviously our own index products where we'd love for them to be able to offer those out through this new technology. But we're very excited to work with the industry on this as an enabler and as the core infrastructure.
Very interesting. That is Nasdaq Chair and CEO Adena Friedman. Lastly, on tokenization, place that's moving pretty quickly here. We will keep an eye on it. Now, still ahead, we're talking about Blackstone's profit jumping 25%, even without a big comeback in deal making. We're going to sit down and hear some of the conversation I had with President John Gray about what's driving that conversation in just a few moments. This is Bloomberg Open Interest. Let's get a check on these markets because we are up on the S&P 500 about 0.1%. Hard to say we're flying, but we are certainly looking pretty good near record highs. Nasdaq 100 up another 0.1%. I've got to say, really interesting here. You have most of the Magnificent Seven up on the day, but Tesla being your big drag on the morning. Now, the 10-year yield is higher, about 3 basis points at 4.4%. But of course, this market is shrugging it off, Matt.
Yeah, absolutely. Looking at new record highs, only up 0.1%, but we soared yesterday after our program. Coming up, June new home sales data coming in below forecast. We'll take a look at the real estate industry next. This is Bloomberg. Tenure would.
I want to check in on Blackstone shares. They are jumping after the asset manager, the world's largest alternative asset manager, posted a 25% jump in profits. And that's thanks to retail and evergreen funds, new smaller investors getting in. This morning, I caught up with the company's president and chief operating officer, John Gray. Take a listen.
Medline is a terrific business, and we own a number of other terrific businesses. And there are often considerations to individual businesses in terms of operational things, transactions, other reasons why you make decisions. But it's also, as we've talked about, a function of the market backdrop. And as the equity markets stay healthy, as the IPO market grows, it's a little bit of a magnet pulling things in. So to me, on some of these great companies we own, it's really a question of when, not if. And when we think it's the right time, we'll do it. Market conditions getting better is obviously very helpful for our business.
Now, I want to read you a quote from Oppenheimer off the heels of your results this morning. They said Blackstone is deploying more in real estate than it is realizing, indicating some bullishness on its part as it puts more money to work than it's taking off the table. Do you agree with that categorization? Can you give any color around how bullish you might be?
I would agree with that characterization. I guess what I'd say is real estate has also been through a tough patch here now for 3.5 years. It was a combination of COVID in the office market and then just the rising cost of capital. Interest rates went up a bunch, and so multiples came down in real estate. Cap rates went up. But we're beginning to see some promising signs as we look forward. We're seeing new supply come down pretty sharply, and that takes a bit of time because of the lag between construction going down and new deliveries. That's going to start to show up in the fundamentals as we head towards the end of the year into next. And cost of capital is coming down. Borrowing costs, spreads, base rates, that's helpful. And we're seeing the early signs of transaction activity starting to accelerate, particularly amongst smaller assets. The CMBS market's up something like 40% year to date. And so real estate's a cyclical business. Apartment demand, logistic demand, these things are not going away, but you have to work through this cycle We're at that point. We're getting closer, I think, to this tipping point where the market sort of bottomed 18 months ago. We talked about that. Then we said it wouldn't be a V-shaped recovery. That's what's happened. But when we look out over the horizon, things certainly look better for real estate. And of course, the way we react to that is by trying to deploy capital ahead of that recovery.
What you're speaking to is an easing of conditions before we've even seen successive rate cuts this year from the Federal Reserve. Obviously, the president has been very vocal for his desire to see much more aggressive cuts than the market is pricing in. Do you worry that cuts, subsequent cuts, could spur another bout of inflation at this point?
Well, I think the Fed has done a very effective job getting inflation down. They were a little late, as we know, originally to raise rates, but then moved quickly. And what we do is look at our proprietary data. We have 250 companies and 13,000 pieces of real estate. And consistently for the last couple of years, others have been talking about sticky inflation. We've just been looking at the proprietary data we have. And it continues to show inflation heading lower. Shelter costs, which are the biggest component of CPI, are running well below the government's 3.8%. And so we think that'll come down. Energy costs obviously coming down. And when we survey our companies about the labor market, they're saying it's the easiest to hire that it's been since COVID. Wage growth is now down back around 3%. So I think the Fed's going to have a lot of good data. We could see an uptick in goods inflation given what's happening in policy. But in aggregate, I think inflation continues to drift down. As a result, I think the Fed has the room to cut rates. So I don't think, given where inflation is, that's going to reignite a bout of inflation. And so I think that will happen gradually. Given the tariffs, given low unemployment, the Fed is being patient. But I think the facts will give them the room to cut rates. And that, again, should be helpful to the economy. It should be helpful to markets.
With all the rhetoric, the push-pull between the president and the Federal Reserve that we've seen, on again, off again, threats to even let the Fed chair go, do you worry about Fed independence from where you're sitting?
Well, in the last couple of weeks, I think we've heard from both the president and the Treasury Secretary that they expect the Fed chairman to continue to the end of his term. I think the Fed will continue to be independent. The president will have a choice to make a replacement here. And I think this system has worked well over time. I think it continue to work well. There's a board of governors as well. So I think the system works. And ultimately, there have been friction between the administration and the Federal Reserve over time. This isn't the first time. But I have a lot of confidence, just like I do in the entire Madisonian system in the U.S. And ultimately, I think the Fed will make the right calls based on the data.
That was Blackstone President and Chief Operating Officer John Gray. And joining us here at the desk, Smriti Popenoe. She is co-CEO and president of Dynex Capital, a real estate investment trust. So, of course, very in tune with the push-pull in interest rates that we've been seeing. Now, here's the question. Even if you believe what John Gray believes, that interest rates can come down at the short end this year, what does that mean? Matt and I have been talking about this constantly. What does it mean for the long end? Because it's not certain for many people that the long end would come down just because the short end is.
Absolutely. And this is one of the most dynamic things that's happened in the U.S. yield curve over the last 24 months is a disinverting of the yield curve, a steepening of the yield curve, where long-term interest rates are actually a lot higher than short-term interest rates, right? And to the extent that the Fed continues to cut rates, it's not a guarantee that long-term interest rates come down because the long-term part of the yield curve, private investors determine the price of that. And that's usually a function of growth expectations, inflation, and a risk premium. And to the extent that there's uncertainty about Fed independence or whatever there is, that part of the yield curve reacts very differently. And so from our perspective, we think really the outcome there is a steeper yield curve.
So I guess it depends on who cuts rates and why that person or the board decides to make those decisions, right? Because I imagine if President Trump were to appoint I don't know, say Scott Bessent, and then Scott Bessent were to cut rates dramatically because President Trump told him to, the market might react negatively to that.
Look, so first of all, it's not a single person that decides this stuff, right?
True.
Like there is a whole group of people, they have to vote. So that's thing number one. Thing number two, a lot of people think of the Fed as really having two mandates, which is maximum employment and stable prices. But they actually have a third mandate. If you go back and look at the Federal Reserve Act of 1977, they had a reform act that was passed at that time. The third mandate is actually to maintain moderate long-term interest rates. And when you take those three things together, that is also part of what the Fed can and will do. They have a toolkit in their pocket right now between QE, rates, the ability to put together any kind of market stabilization program. So they have the toolkit that they need to manage the yield curve if they want to.
But, you know, one thing that I think is interesting is also the impact that the long-term rates have on the mortgage market also, because you're back to mortgage rates above 6.8% and a conversation around the privatization of Fannie and Freddie.
Yes.
Now, you worked for Freddie as managing their investment portfolio for almost a decade when it was private.
Yes.
So what do you think the impact would be if they achieve the privatization once again?
Yeah, and it's going to be very interesting to watch how that occurs. The most important piece of information that's come out about privatization happened in late May when President Trump actually tweeted out or put it on Truth Social that if the GSEs were to be made private, the mortgage-backed securities that have been issued by them would maintain their government guarantee. For investors like us, that's all you need to know, right? So that's really the biggest driver of what that mortgage rate is. So if you've got that government-backed guarantee, that helps you with respect to mortgage rates. Whether they're private or not, the ultimate structure and how they go about it, whether it's fast, whether it's slow, all of that will impact, the ultimate mortgage rate. But having that guarantee really gave the market a lot of confidence that things won't get out of control.
If I look at the average rate of the federal funds target rate over the last 50 years, say through the financial crisis, right? Not including the ZIRP period. We're below that still, right? It's, I think, 5.75%, and we're at 450. So is this really too high? Are we in a high rate environment?
You know, in the large scheme of things, I would say maybe a little high, like maybe there's room to cut rates 50 to 75 basis points here. And I'm saying that just because we're watching the labor markets, and I think Chris Waller said they're dangerously close to the edge. We think they're walking closer to the edge, maybe not quite at the edge. So there is room for the Fed to lower rates here. But in general, we're going back to an environment where, we have a lot of debt outstanding in the world. That debt has to be priced appropriately. So by and large, these don't seem like abnormally high or abnormally low levels of interest rates. They seem actually pretty fair here.
Let me ask about the housing market, because we got yesterday existing home sales that were a disappointment. And in general, it's been a tough, especially, now residential has been bad and the demographics don't look great either, right? How does that play out, you think, over the longer term, 5 years, 10 years?
So existing home sales levels today are about as bad as we've seen them in, even since the crisis, right? And that's a reflection of the 7% marginal mortgage rate on 30-year mortgages. And if you go back and look at existing home sales over time, what you'll find is they go through boom and bust periods. We are in a bust period for housing right now. It's directly related to the level of mortgage rates. To get that market moving, you need lower mortgage rates, period.
But Smriti, what about the demographics? We're going to have, all of us are going to be 70 years old and older, right?
Yeah.
There's no more kids to start families.
So then you've got this idea of the silver wave where the aging boomers are trying to get out of their houses. There was talk this week about reducing the capital gains on house gains, selling your house and getting the capital gains. There's a tax on that now. If you reduce that, maybe that creates a little bit of velocity. But look, behind the boomers are the millennial generation. The millennial generation formed households late, and they came into the housing market late. They are still there as a source of demand for housing. Okay, so that's not going to be gone anytime soon. So they will be there to catch what I think is what the boomers are going to sell eventually.
Smriti, we thank you so much for joining us here on set. That is Smriti Popenoe of Dynex Capital. We got to leave it there, but of course, complicated housing market and complicated interest rate environment too. So to talk more about that, coming up, Counselor to the Treasury Secretary Joe Lavorgna discusses the impacts of tariff-driven inflation, if they're seeing any, and the revenues they're bringing in from it. Importantly, stick with us. This is Bloomberg Open Interest.
I'm not really sure what the Federal Reserve is looking at because thus far we have not seen, or we've seen very little, if any, price pressures from the tariffs. And if we were to see those, they wouldn't be inflationary, it'd be a one-time price adjustment.
Treasury Secretary Scott Bessent telling Bloomberg that tariffs would be a one-off for inflation. Let's bring in Counselor to the Treasury Secretary Joe Lavorgna in Washington. Joe, I'm actually very curious about where you think that these rates are actually going to start leveling off, because you went from 10% to 15%. The market had been digesting that double-digit percentage in tariff rates. Do you think that it could be higher, much higher for countries that would bring the ultimate global rate above that 15% level?
Sonali, thanks for having me. It will depend, as Secretary Bessent has said many times, on how negotiations go. As he highlighted several weeks ago, there would be a bunch of deals all coming through as people were eager to negotiate with the U.S. And, of course, President Trump came in and solidified a great deal with Japan, among other countries. And we'll just have to see how things progress. As you know, with China, the Secretary said earlier in the week, we're in a good place. He is going to Stockholm next week to negotiate with his Chinese partners, so we'll see what happens. But clearly, we've made a lot of great deals with some really huge trading partners. So we're progressing, and we'll see what happens from here on out. But as you mentioned, the tariffs have generated significant revenue, as we thought they would. We could end up with $300 billion or thereabouts in calendar year revenue. That's stunning. And as the Secretary highlighted, and this was the case well before these tariffs were even implemented. Even last year, we were talking, or he was talking, I was saying it in the private sector, that there was not going to be an inflation impact because inflation is always and everywhere a monetary phenomenon. If there even was a tariff effect, it would be a one-off price level adjustment, and we've yet to even see that.
It does seem that, first of all, revenue could be higher than $300 billion, right? If we have a base rate of 15% on essentially $3 trillion of goods, you could see $400 or more billion dollars. You could see $4.5 trillion of revenue over the next decade. How do you see that shaking out, Joe?
So you're correct, Matt. And again, the $300 billion is just based on current trends. If those rates turn out to be higher, then yes, the revenues will be higher. The CBO, when it did its analysis of the tariff several weeks ago, thought it'd be around $3 trillion. That's important because they erroneously, in my opinion, we could talk about, scored the one big beautiful bill. They originally scored that as adding $3.4 trillion. So basically, the tariffs would effectively wipe that out, and that was with ridiculously pessimistic forecasts. What I see playing out is the following. We have a Capex boom. We could talk about that. We're seeing that in the data. We're seeing a boom in blue-collar wages because President Trump's energy policies have lowered inflation significantly. And the Capex story will lead to further wage gains through productivity. And to the extent that tariffs induce more countries and companies to relocate here, at the same time the incentives from the One Big Beautiful Bill encourage more domestic production, you'll get faster growth and low inflation. So it's a win-win. So we think you're going to see a real boom in the manufacturing base, higher living standards, and bigger paychecks for Americans.
Can I ask you about the Gold Card program, Joe? Because it sounds like a niche issue, but I've heard Secretary Lutnick talking about 75,000 applicants, which would be also like $400 billion in income that you could potentially see on an annual basis. So is that program set to move forward? And do you have any idea what scale?
What I can say is I'm not sure what exactly will happen with that program, but I think the most interesting thing about the program is just how creative and visionary the president is. I mean, he totally thinks outside the box, and you could see this week with the innovation fund that he is basically pushed through at a higher number than even the Japanese originally wanted. He's pushing that through in that deal, $550 billion. And the profits almost entirely going to U.S. entities. That's like pretty cool. That's pretty innovative itself. And, you know, all these things that President Trump is coming up with is just a new way of thinking about how things can get done. You know, President Trump wrote the best-selling book, Art of the Deal. It's also, you know, producing the art of the impossible. And I know that sounds like it's exaggerated, but in reality, it's not. And I think we go in these really cool directions.
Joe, I want to go back to something you were saying about Capex spending. It is clearly something you and the Treasury Secretary are looking at. But when you look at the breakdown, it's pretty interesting. You can see the spending on industrial production as it pertains to information processing just really taking off. But you don't see that same uptick at that rate by any means for the parts of the economy that are more manufacturing driven so far, more production, more kind of classical production, if you will, industrial production. So when does that start to catch up? Because ultimately, go ahead.
Yeah, no, that's a great point. So if you look at, we have a 24% increase in the official GDP data. The AI, computer, innovative part of the economy grew over 70%. But industrial equipment itself grew almost 5%. That's a pretty strong growth rate. Transit equipment was up about 7%. So we did see some of that growth in the first quarter. It was just overshadowed by the AI boom. And as we build data centers and become the leader in digital assets and crypto, that will further foster high-paying manufacturing jobs. And the fact that the One Big Beautiful Bill has the 100% expensing for factories and plants, something that we never had before in tax policy, means we're going to get the building. So some of the older industrial aspects of the economy will start to benefit from that. It's just that this bill was just passed, you know, a few weeks ago. So I'd imagine we'll break ground on a lot of these new projects soon, and you'll start to see things like structures, which actually aren't part of Capex, actually pick up in a pretty meaningful way.
Mr. Counselor, appreciate your time. Hope we can get you back in the studio soon. Counselor to the Treasury Secretary, Joe Lavorgna, out of Washington, D.C. This is Open Interest. Let's get a check on the markets right now. We are looking at some big green arrows with the S&P 500 at 6,376. The Nasdaq also gaining a 0.25%. Let's get a look at some of the single stocks at this hour. ServiceNow.
Yeah, pretty
interesting. Which is good because Bill McDermott's coming on later.
He is, and this is another AI story, customer adoption of AI tools. We want to see a B2B adoption here as well as a B2C adoption. We're also looking at Mattel, also really interesting to me because you're seeing it just plunging about 12%. They reissued a sales growth forecast that was crimped by tariffs. Chipotle also cut its annual outlook.
You don't need $30, Sonali. $1 or $2.
Don't tell me how many dolls I need, Matt Miller. How many burritos do you want?
I want way too many burritos, and I'm hoping instead for a supply of Wegovy to cut that consumption. Coming up tomorrow, we're going to speak with the CEO of the prediction market Kalshi, which is absolutely fascinating. Also the CEO of Reflexivity, which has nothing to do with indigestion, and an AI firm partly owned by Stan Druckenmiller.
Super interested in the AI trade over there, as we know, public and private. Looking forward to that conversation next. Matt, really interesting. Today might be another day of records.
It could. Well, it is as we speak. And it could be if the trend continues of markets rising from here on out. This is Bloomberg Open Interest.